It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being with us. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the show. With me, certified financial planners and my business partners, Kevin Korhorn and Josh Gregory.
Yeah, tax preparation is not tax planning. They're two different things, and it's important to understand that. Now, you have a couple more days to be in compliance with the IRS about what happened with your income and your financial life last year. Now, that's called tax preparation. Tax planning is making proactive decisions and applying creativity to your situation to see how you can improve your tax situation and make sure that if there are any opportunities out there, you're pursuing them. So we'll share our favorite tax planning concepts coming up this hour.
That's right. If you have any questions for us, taxes, there's a whole bunch of questions coming in for taxes. We're going to hit some later on in the program. If you have any questions, reach out to us. You can do so a couple ways. WiseMoneyRadio.com is how you find us online. Submit questions right there on the right. Call or text 574-222-2000. 574-222-2000. Call or text. And then social media, Facebook, YouTube, Twitter. Just search Wise Money Radio. All right, week 3 of our series on the most valuable planning concepts in each of the 6 areas of your financial life. Now, tax planning is the 3rd area, but I told you there's 6. Present financial position, we've hit that, talked about the most important planning concepts there. Last week, we talked about protection planning. That's insurances, risk management, so on. Today's tax planning. Next week, we're going to be talking about investment planning. That's like dessert. It gets a ton of attention when it comes to finances and investments. We're going to talk about that next week. Retirement planning and college planning, that's area number 5. And then estate planning, capping it off, is the 6th area. You cannot talk about one area independently of the others. You just can't. We're trying to, but that's just for simplicity reasons. But every decision you make in your financial life is going to touch, at least 4 of those, if not all 6. And so you need to make great decisions every time you're faced with them to make sure that you have synergy and are creating synergy in your financial life. Very, very obvious, not normally, but very obvious to us professionals, how every financial decision you make impacts your taxes. So Josh, share again, how would you define tax planning before we talk about concepts? How would you define it?
Well, I think it's the same word that Kevin used at the open here. It's being proactive. That's the probably dominant word, I think, that describes the difference between being a planner versus someone who's just being in compliance with the tax code. It's more future-based as opposed to looking backwards and saying, well, what happened in 2018, for example? How do I get all the right numbers in the right boxes? How do I not leave any tax deductions on the table? Don't want to pay more than my fair share, right? But taking a multi-year approach,
Yes,
maybe even a multi-generational approach to examining your tax picture is what sets some folks apart as really successful in their financial life versus those who are just getting by. That word proactive, looking further down the road and deciding what could you do today to make the future better. There are examples of this all over in the tax code if you have eyes to see it.
Yeah, and if you've ever sat across the table from 3 adult children who say, okay, so mom and dad are both gone now, what did they have? And you show them, well, look, these are their assets, and this is the amount of money that they have in Roth IRAs because we've been converting since 1998 when the Roth IRA first became available. And they look at that and they say, so you mean we're not going to have to pay taxes on this money? We say, no, mom and dad were paying taxes all along because mom and dad wanted to pay as much as they could in tax in the lowest possible bracket. And they did that consistently year in and year out. And now you sit under the shade of that tree.
That's awesome.
I've seen that look that they give you after you say that, and it is it's a look of, I mean, there's still emotions going on, but a look of appreciation and respect for the planning process. And for some, the light bulb goes off that, okay, wow, I see the power of planning here.
Yeah. I have a client in mind right now who unfortunately lost her mom just a year ago, less than a year ago. And every time we talk about the resources that were left behind, these tax shelters that she inherited, some of them IRA dollars, some of them Roth dollars, tears well up because she recognizes that it was, she even uses the phrase, it was love that drove mom to sacrifice, to save, to pre-plan, and she gets to be the beneficiary of that now, and it will bless not just her, but her children and maybe her children's children ultimately.
Yeah. All right, so you need to have a planning approach with your taxes. You need to have a planning approach. That's advice number one, right? However, with all of the creative tax strategies that we've been involved in, that you've seen, guys, what would you say is the most valuable planning concept in the area of tax planning?
To me, the word tax shelters comes to mind. We often think of financial planning as trying to grow resources for the future, building up a nest egg, for example, so that someday when you're no longer working, you have a way to replace that paycheck, supplement things like Social Security, that sort of thing. But how you build it matters. Where you build that nest egg matters. And what I'm talking about are all these different types of accounts that exist out there. The tax code has built all kinds of vehicles that you have at your disposal, ways that you can save and build for the future with money outside of the reach of the IRS for some period of time. And these tax shelters are what give you the ability to have influence on the timing of when you pay taxes. You get to decide whether you avoid the tax today and pay it in the future, or vice versa. Maybe you decide, no, it's better for me to pay the tax now at a low rate, and out there in the future, I won't care what happens with tax rates because it's already prepaid. The timing on when you pay taxes is influenced best for most people by how they use tax shelters.
Yeah, I think when I think of the best tax strategies or best tax ideas, it's the one that's hidden in plain sight. It's the 401k or simple IRA or whatever that pre-tax retirement plan is, because there is such incredible power and for most people, the most powerful wealth building tool they will have in their entire life is their retirement plan at work. So that's not everybody, but for most people, the way you're going to build the bulk of your wealth is through the retirement plan at work. So it's interesting to me when I'll hear someone say, well, I'm not putting money in my retirement plan at work because my employer doesn't do a match. I'm like, oh, so you're willing to cut off your nose to spite your face. That doesn't make any sense. That bucket that you can put a bunch of money into and not pay taxes today, but defer the tax payment to the future. And oh, by the way, as those dollars are growing, you're not paying taxes on the capital gains that are spun out, on the dividends that are spun out, on any of that. So it's such an incredibly powerful tool that I would encourage you, if you're not taking advantage of that tool, I would encourage you to understand how that fits in your financial life. Because you could hear me say that and say, well, if that's the most powerful tool I'll ever have, then I'm going to go and hop on the computer and crank up my deferral percentage and max it out. Well, that's a good idea as long as your student loans are paid off, as long as your emergency fund is funded. So don't hear any of these ideas and rush out and implement them in a vacuum. Implement them in the context of a complete financial plan.
Yeah, So, Josh, you mentioned utilizing tax shelters. Kevin, you mentioned the 401k, specifically pre-tax. I'm assuming you also mean the Roth side of your 401k, just using your 401k and using those tax shelters to your advantage. I've got a tax shelter that made the top of my list that we've talked about on the show. We've devoted an entire episode of Wise Money to that concept. We're going to talk about it in just a bit. And then also some other tax planning strategies that not be too late for you to implement if you haven't done so already. So that and more coming up here on Wise Money with Korhorn Financial Group. All right. You were looking at the list. You were like, what's he going to say?
Yeah, I wonder.
You
You usually hold something back.
I don't know.
There's
Let's
the
see.
This is a
common man's outline, and then there's the Mike Bernard outline that has the real answers.
Yeah, this is the last time I'm going to let Josh go first. Because he
All right.
takes the answers.
Ready? Are you making the best use of your tax shelters and leveraging that to enhance your financial life? I hope so. I hope so. We're going to talk about those. We've been talking about them. This is Wise Money with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Thank you to the attorneys at Ledoux, Curran, and Keene for making the Wise Money Show possible, as well as First State Bank. Thank you, thank you, thank you. If you have any questions, we're going to be hitting a few later on in the program. You can submit them in a couple different ways. You can call or text 574-222-2000. That's 574-222-2000. You can find us online, submit questions that way, wisemoneyradio.com. And then all over social media, you can send a question that way as well. Occasionally we get some through Facebook or through the YouTube channel. And so Facebook, YouTube, Twitter, just search Wise Money Radio. Subscribe, get all the updated content, all that sort of stuff. You can submit questions there as well. So we're in the middle of our series about the most valuable planning concept. Josh, Kevin, and I encompass over 50 years of financial planning experience. And so in all that experience and the education and so on, it's the most valuable planning concept we've seen in each of the 6 areas of financial planning. And we're talking today about tax planning. Gosh, we could talk for hours about the different planning strategies. The one that tops my list is funding your HSA and not spending it. And here's why. Josh, you talked about tax shelters. Kevin, you talked about, I love what you said, the one that's hidden in plain sight, the 401k. Very well said. With the HSA, though, it's unlike anything else that I know of in the tax code, in that you can put money into this account and deduct it on your taxes, and then you can use that money and not have to claim it on your taxes. The next closest thing is what? Owning your own business? You don't, right? So, but this is the double benefit. So you get a tax benefit going in and no tax paying going out. You might think, oh, no, that's the Roth IRA. The Roth, you don't get a tax deduction when you put the money in. Yeah, you pull it out and that growth is tax-free, but the HSA is different. And so we talked about this recently. We did a show about the HSA. And the reason why some of the things that we've talked about is fund your HSA so you get that tax deduction and then don't use it. If you have out-of-pocket medical expenses, just shoebox those. Pay those out of cash flow. You've got to have margin in your financial life. So there again, this area of your financial life impacts all the others. But then just hold on to that receipt. And someday in the future, you can reimburse yourself for that, pull that money out tax-free. The reason why I bring this up is for a long time, flexible spending accounts were more prevalent than HSA. I think that's changed now. I feel like it has. But the idea with flexible spending accounts was, well, I think I'm going to spend, I'll go to the dentist twice. No, really, I'll just go once. And I think I'll go to the doctor this much. So I think I'll spend $1,000 in health insurance or in health expenses this year. So I'll put $1,000 in my flex. So it's a one for one. It's a different mindset. You've got to have a different mindset with your HSA. And then to take it one step further, if you're not going to use that HSA, that money for the long term, well, what does that sound like? You should invest it. I'm not talking about what I think the market's going to do this week or over the next year. But if it's long-term money, invest it. You've got that tax-deferred growth, that tax-free growth.
A couple caveats to that. When you tell your spouse, especially if that spouse is in charge of most of the medical decisions, hey, honey, we're going to invest the HSA this year instead of pulling it out to use for the broken bones and the fill in the blanks. there might be an adverse reaction.
Hypothetically, right?
It's possible. It's just.
The same warning would go to you financial planners who might be listening too. If you want to bring that up to clients, there might be an adverse reaction. You mean I'm going to set this money aside and I'm not going to use it? You're killing me.
Yeah, so especially if they're used to using it. If you're used to putting the money in, pulling it out, put it in, pull it out, put it in, pull it. So the idea put it in and leave it. So that sounds like to the controller, at least the financial controller in the family, hey, I just took a $7,000 pay cut. And that's true. You just took a $7,000 pay cut. So what you have to do, this is why the 6 areas of CFP are so important. You need to make sure that you can take a $7,000 cut and still get the medical bills paid. And if you can, it's a great strategy. And so if we want to get a little technical on this, if you own a percentage of a business, you can't put money into an HSA through payroll deduction.
Yeah, right out of your paycheck.
But really the best way to put money into an HSA is right out of your paycheck because you don't pay your half of the FICA and Medicare tax. So that's you save, if you put $1,000 in your HSA via payroll deduction, you just saved $76.50 of taxes. Well, take that 7 times 7,000. That's $500 that you could save.
You're so much better at math on the radio than I am, Kevin.
That's right.
Yeah, sorry. Go ahead, Josh.
Well, he may have done it wrong, and you wouldn't have caught it, though,
I wouldn't
either.
have caught it. You can't talk, think about the outline, the time, and do math at the same time. Come
That's
on,
right.
people.
You know, the moral of the story here, though, is know which tax shelters are available to you.
Yeah.
Because a health savings account, that's not universally available to everybody.
Nope.
You have to qualify to be able to participate in something like that. Do you? You may have an employer that gives you multiple options on how you structure your health insurance at work. And if you haven't given careful thought to that HSA option, if they make it available to you, you need to. Mm-hmm. And unfortunately, you have to make that type of decision during an open enrollment period. So tuck this away. 6 months from now, you need to dust off that knowledge a little bit and consider whether or not the health savings account could be something that applies for you.
All right, so we're talking about the most valuable planning concepts, and I'm going to just go a little Kevin Corhorn here and give you my second one. The first episode, if you missed it, Kevin said, okay, my most valuable, I've got 4. So my second one is something called the Retirement Savers Contribution Credit. And what in the world is that? If your adjusted gross income is below a certain amount, and you're saving up for retirement, the IRS gives you a tax credit. Oh, you mean like a deduction and so I'll someday have to pay it back? No. Free money for doing something that you were going to do anyway? Or, sorry, Kevin, sorry.
I wondered if he was going to have a reaction to that.
He breaks out in hives. It's your own money. You're getting
Free
it back.
someone else's money.
That's right. You're
I
getting it back.
naturally flinch when someone says free money because I'm waiting for
Filtered
Kevin
through the
to,
government
to
You
correct us.
You get more of your own money back, but you never have to repay it, and just for doing something you should be doing anyway. Now the catch here, and this is why I see. That's why I'd say it's my second most valuable. Is it's not for everyone. Your adjusted gross income needs to be, and I don't have the exact number in front of me, but for a married couple, I think it's below 60,000, maybe below 55,000. So it's not high income where this applies. And so the reason why I like it is when you're at that stage, either earlier in your career or if just one spouse is working, there might be a whole bunch of reasons for you to not be saving for retirement. And you get an extra sweetener above and beyond what other people get for doing it anyway.
Yeah. We love tax credits. It's one of our favorite tax phrases ever because it is money in your pocket. If you get $1 worth of credit, that's $1 less in tax.
It's like free money.
Kind of like free money, right, Kevin? One of the other places that we love to highlight free money from the state of Indiana is using a tax shelter for college planning. The Indiana 529 plan puts money back in your pocket when you contribute to it as a Hoosier. If you're a resident or at least filing an income tax return in Indiana, you can be eligible for some free money for doing something that you plan to do anyway.
Yeah. There's one more that I'd throw in there, and then we've got a couple more that we'll hit in the next segment too. But the backdoor Roth IRA. We've got a question coming up. I don't know if we'll be able to hit it, but hey, I make too much money, and my CPA told me I cannot contribute to a Roth IRA. Is that really the right answer? And I don't know. Might not be. You might be able to do something called a backdoor Roth IRA. We've been doing that before it even had that catchy phrase to it. So, all right. We also are going to hit what are the biggest tax planning mistakes, and we're going to share those with you so that you can hopefully avoid those. So, a lot more still to come here on Wise Money with Korhorn Financial Group. Sorry, I ended a little bit early there.
That's fine.
But that was segment 2, right?
Yep.
I'm starting to get a little squirrely.
I was there in the middle of segment 2.
All right. Any others that we want to hit?
I have one more.
Okay.
I don't know if it's sticking with the actual title of the show, are most important, but it's at least some of the ones that get missed or people don't recognize.
Yep.
So mine's for small business owners, so we can hit
Mine
that. Love it.
would be encapsulated in the backdoor Roth IRA
Okay.
because I would say the other side of that coin is the front door Roth IRA, and people understanding that you can do a retirement plan at work and fund this. Most people think they're mutually exclusive, and it's not.
Yeah. Okay. Do you have creativity being applied to your taxes? I don't mean that. I don't mean craftiness with your taxes. You need to be above board, but do you have creativity on what sort of planning opportunities are out there, and therefore which ones in your financial life that fit that you should go after, and which ones you should avoid? Your certified financial planner should bring that confidence, clarity, and creativity. We're talking about that today. This is Wise Money with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard. Here with me, as always, in the KFG studios, Kevin Korhorn and Josh Gregory. Thank you to Bethel College, soon Bethel University, Adult and Graduate Studies, as well as Diane Bennett and the Inspired Homes team for partnering with us on the Wise Money Show. Thank you very much. Also want to remind you, if you have any questions, we're going to hit a couple here in just a moment. Reach out to us. You can do so in a couple different ways. Call or text 574-222-2000. Put your name at the beginning, where you live, your age, 574-222-2000. You can send us an email. You do that by going to wisemoneyradio.com and fill out the submit a question area right there on the right. That turns into an email, goes directly to me. And then lastly, all over social media, we've got a Wise Money Radio presence on YouTube and Twitter and Facebook, and you can submit questions that way. You can also catch a whole bunch of other content. Every show's on the YouTube channel, blogs on Facebook, all that sort of stuff. So reach out to us that way. All right, we are in the middle of our series on the most valuable planning concepts in each and every part of the 6 areas of your financial life. Today we're talking about tax planning. Boy, coincidental with the tax filing deadline just a couple days away. Josh, we've hit a few. What are some other very valuable, maybe not the most valuable, but worth highlighting planning concepts in the area of tax planning?
One that we see on a pretty regular basis because we serve a lot of small business owners is choosing wisely how you structure your business. A lot of people maybe underestimate how much influence your entity structure. And what I'm talking about is, are you just hanging a shingle and starting a small business? Maybe you have some kind of side hustle that you do and you have a normal day job, but this is just a little business that you started on the side. If you haven't created any kind of separate entity, separate from yourself, I should say, then you're a sole proprietor. And that's an important term because it has tax implications to it. And you're going to pay self-employed or self-employment taxes in addition to all your normal taxes. Well, there are ways for you to maybe change the nature of some of that profit from your business. Things like an S corporation, for example. Some small business owners just simply by changing the way they file taxes for their business, by creating an entity separate from themselves, they can dramatically reduce the amount of taxes that they pay. And you do that year after year after year, and that has an economic benefit that accrues to you instead of the federal government. That puts you, closer and closer, more and more within reach of the financial goals, the financial life that you're trying to accomplish.
Yeah, but I would even expand on that. It's not just an adding impact for you. It's a multiplying impact, because when it's your business, you now have more cash flow and more resources to then hire and expand and invest and go after that next thing. And that's a multiplying effect on the people that you employ, on the community in which you work. So, fabulous point. Most people don't know where that decision fits in their financial life. Yeah, it's housed in tax planning. That's a tax decision.
Yes.
So,
And it's a decision that you kind of default into when you first start your business. But if you don't revisit it as your business grows, as you gain more success, you may miss some years, some opportunities. We see it all the time where people are still kind of doing it the way they always did it, and realize, boy, now that this business has grown to a size and success level, it maybe creates more tax pain than is necessary. They need to rethink how they've done things.
Yeah, so the logical question that comes out of that is, well, how would I even figure that out? Who would I talk to? And we would encourage you to talk to a certified financial planner, someone, but also, I mean, and here in the spirit of shameless self-promotion here, one of the advantages to talking to one of the CFPs at Korhorn Financial Group is that we have a full-service tax and accounting firm right here in-house, and we work very closely with a number of attorneys. So solving that problem is actually fairly simple if you get the right help from the right people.
That's right. You have to have the right team in place.
Yep.
And what many people are missing, they have that CPA. They think they're the trusted advisor. Not always does the CPA bring creativity. Many CPAs, and this is not everybody, so don't take this as a criticism, but many are very left-brained and very analytical and not always bringing creativity. Same thing with a lot of attorneys. So sometimes injecting just one more professional into the mix, there might be one missing piece in this puzzle, and it is a certified financial planner quite often.
it's not just the creativity, though. Who's quarterbacking all of that?
Right.
Who's making sure that everyone's staying on the same page and that it all fits for both your short term and your long term. That's your certified financial planner. All right, let's flip the script a little bit. We've talked about the most valuable. Now, what's the most common mistake that we've seen people make when it comes to tax planning? What do you guys think?
Not planning.
Right.
Right?
Well, the simplest planning mistake that I've seen is that I don't understand fully what I'm doing, and therefore out of that springs a whole bunch of stuff. If I'm on the spectrum of I'm young and I don't file my taxes. Well, listen, get your taxes filed because you're likely going to get a refund. If you're 16 or 17 and living at home, get those W-2s around, get your taxes filed, and get that refund. But most people don't fully understand the theory of income taxation, and you can study it for years and not fully understand it. But you need to understand some basic concepts, and you need to understand what your tax filing status is and what you should expect to pay in taxes and how those taxes are going to get paid. Because if you don't and you get behind, then that and kind of a downward spiral, if you will.
Absolutely. You may be listening today thinking, oh, I'm so glad I got my taxes prepared. I have that off my plate for another year, right? And in reality, I would want to change your thinking, change your perspective on that to say, okay, 2018's done. I filed my tax return. Great. Now immediately begins the work of planning your 2019 return. And this is what many people don't do because they're relying upon a tax preparer to just get last year's return filed accurately for them. And they're not leaning on maybe that same professional or a certified financial planner may be a better option to help you start turning your focus towards the future and the things that you can be doing to influence this year's return and beyond. If you haven't run a tax projection, a forecast of what your 2019 return is going to look like by October of this year, then you may be falling into the trap of believing that taxes is just, it's something that you do during a certain season of the year, and that's it. No, tax planning is something that you should have on your radar screen all throughout the year.
Let me just remind you, every time you get your taxes done, you need to answer 3 questions. Your taxes are not done unless you answer these 3 questions. And the first one is, do I understand where every number came from, and is this an accurate tax return? So, okay, there's 2 questions in that one. But, so, is this return accurate? Do I understand it? The second question then is there anything I can do right now to improve that return? Last year, even with just a couple days left, is there something I can do? Yeah, actually, you could, possibly. And then you evaluate all those options. And then the last one Josh just talked about. How's my financial life, how's my tax situation changing for this year, and what should I be doing about it? We've talked about that quite a bit. I challenged myself. Are those still the right questions? I think so. Is there a 4th or a 5th or a 6th question? I don't see it. But depending on your process of getting your return prepared, that's going to influence how many of those questions you will answer. If you're doing it online, you might not answer any, actually. If you're not doing a planful approach, you probably aren't answering the 2nd and 3rd. So, all right, we've got one more, in my opinion, biggest mistake when it comes to your taxes, and then a couple great questions coming up here on Wise Money with Korhorn Financial Group.
Hey, is it okay we left out the Roth IRA?
Roth IRA for, no, because I'm going to hit it.
We're hitting into the next segment.
Yeah. I wanted to
Is that
pick
through
the story.
David's question?
No.
Is that what you're using to springboard into it?
Yes. But I'm going to pick up on the Lauren story that I started, I don't know, 2 segments ago or 2 shows ago. Rendition number 2. I mean, the Lauren story could be the book. It could be the fable. Oh, I might need to expand on that a little bit in some contemplative time.
Write that idea down, dude.
Yeah. All right, ready? We are landing the plane.
The plane.
Thank you so much for being with us today. This is Wise Money with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. If you've missed anything, several ways you can catch what you missed in this episode and every other. First, the YouTube channel. Every episode's right there, and you can just subscribe to it. You can share it. You can submit questions that way. Just search Wise Money Radio on YouTube. Every episode's also on podcast, wherever you listen to podcasts. Wherever. Just search Wise Money with Korhorn Financial Group. That's Korhorn with a K. Subscribe to it, share it, all that sort of stuff. And then lastly, you can listen online, wisemoneyradio.com. You can, I think it's the previous 10 or 15 episodes are right there, but then there's also a link to the entire episode bank, and you can listen there as well. Submit questions right there. While you're on the website, you can read the latest blogs, all that. So a whole bunch of stuff on the website, wisemoneyradio.com. All right, before we transition to questions, we've got a great one here from David, but I see it as, I think, the most common mistake is in the area of tax planning. A couple episodes ago, I talked to you about my friend Lauren and how she needed some help investing. And we spent a whole hour talking about, the first hour, talking about nothing related to investing at all, but about the blocking and tackling in your financial life. When we finally got to investing, let me remind you, I think she's 24, and she's making about $35,000 a year, single and very frugal, so doesn't really spend. That's why she's saved. And when we finally started looking at her investments, she's just like clockwork, saving pre-tax into her 401k. 24 years old. And I don't know. I don't know exactly where she stands with retirement savers credit and other things. Pre-tax, maybe getting that deduction does amplify her situation in a multiplying type way. But my goodness, at 24 years old, I'd much rather have that. Much rather pay a little bit of tax today by only making 35 grand. She's got potential. She's sharp. She's going to be able to grow and develop and be making a lot more than that someday. So you would argue she's in a pretty low tax bracket today. And then you'd also argue that money has a long time to grow. And I think I'd want her to pay the tax now so that all that growth is tax-free. And so just quickly, we actually logged on together and to her 401k, and I said, take that number right there, that pre-tax amount, make that 0. Take that Roth amount, make that 15%. Plus, you've overfunded your emergency fund and some other things. I mean, that's relative, but we're going to fund your Roth IRA as well. So while you're young, we're putting a whole bunch of money set aside for the long term. You'll never have to pay tax on that money again.
That takes a powerful vision for the future to be able to make that sacrifice, especially when you're young and trying to live on the lowest income that maybe you'll ever have in your life, right? So tax savings may seem really valuable to you, but unfortunately, when you're in a low tax bracket, you're not getting a lot of bang for the buck by putting money into a pre-tax account. So it's going to cost you less, truly, today to save money into that Roth IRA than ever in the future, and you get the power of letting that money grow tax-free forever. So what a wonderful story. People like Lauren out there who are thinking way down the road and taking the right action today. That is fantastic. Yeah,
Albert Einstein called compound interest the eighth wonder of the world. And what you do is you get that working for you. And on a similar note, my son Joshua, who's in the Army, is saving 60% of his paycheck into the TSP, which is the thrift savings plan. That's what you, when you're working for the government, that's what you get.
Thrifty.
Yeah. And he's putting that on the Roth side of the equation.
Awesome.
That's awesome. So because he said, well, Dad, what happens if when I get out of the Army, I want some of that money? Well, I didn't want to tell him this, but the dirty little secret is you can get back what you paid in to your Roth IRA. Yeah. As a matter of fact, the government wants you to take back what you paid into your Roth IRA. Because if you take what you put in back out of it, they're only, you're limited on how much money you can get into a Roth IRA. So the government has an incentive to get you to take money out of that. But one thing that I would say is you want to understand when you think about tax planning, what is your tax situation? Should I pay tax on it now or should I pay it later?
That's right. That's one of the most valuable concepts is choosing between pre-tax or Roth, making an intelligent decision there, and then the converse is that mistake. And I think a lot of people are just picking one, and really not being planful, not being intentional about it. That weaves right into the first question we're going to hit today. David's 56 from Granger. I am told that my wife and I make too much money to contribute to a Roth IRA. I contribute the maximum I can to my company's 401k, but would like to put money into my Roth too. Is no the right answer, or is there a way I can actually get money into my Roth? It's a good question, David. We don't know all the circumstances, but maybe.
Right. So you have to be eligible to make a contribution to a Roth IRA each year. And the way you determine whether you're eligible is we first ask the question, did you have earned income? Do you have a paycheck or some sort of, profits from a self-employed situation? Earned income is the first qualifier, but sometimes people make too much money. And if you were single, you start getting phased out. You hit certain thresholds of $120,000 per year up to 135. If you fall in that band, then you're not going to be able to make a full contribution. For married folks like David, it's 189 to 199. I'm talking about 2018 values here. These numbers have gone up for 2019. So if your income gets above these thresholds, then you can no longer make a direct contribution to a Roth IRA. And instead, you have to consider whether or not there's a creative way to do a backdoor Roth IRA. Mm-hmm. You want to share what that is, Kevin?
Sure. So the backdoor Roth IRA, and there are a few things. It's a simple concept. It's that you start in a traditional IRA and then you convert it to a Roth. There are a couple ways to get money into a Roth IRA. One is to contribute, and the other is to convert. So you can move money from a traditional IRA to a Roth IRA, and when you do that, you pay taxes on the money that you move over. Well, if you put after-tax dollars into your traditional IRA and you move it over, there's no tax bill on that. But there's a for every gimme, there's a gotcha, and you want to be really mindful of this. If you have other IRA money, the IRS doesn't let you say, "Well, you've got $100,000 in your IRA."
That's pre-tax over here.
That's pre-tax. You just put $7,000 in. You get to peel the $7,000 off the top and convert that. No, the IRS looks at it as pro rata, so they look at your 107, and they say there's a very small part that was after tax. Most of that was pre-tax, so pay taxes.
Some of you are listening right now thinking, "Oh no, I'll get around that. I'll just put it in a separate IRA." No, they aggregate all of your IRAs now.
And simple IRA.
And simple
IRAs.
Yeah. So you've got to be very, very careful with that sort of stuff. And then also some of you are thinking, well, wait a second. If I can't put money in my Roth, why would I put money in my IRA and not deduct it? Well, you likely aren't able to. So there's some logic here, but work through that with a certified financial planner because there's some traps like we tried to talk about. We don't want you to get bit by one of those.
And a quick answer to that question, why would I put after-tax money into an IRA if I couldn't convert it to a Roth IRA? Because if you're in an income situation where you can't deduct your IRA and you can't convert it to a Roth IRA, tax deferral is so powerful. Build that up, and right on the precipice of retirement, there's some planning that you want to do. It's almost like a magic trick, but you can get access to that money that you put in after tax and not pay any taxes on it.
So that's the creativity that you need to be employing into certainly your tax situation. We would argue your entire financial life, where your financial advisor, your financial planner should be bringing confidence and clarity to your financial situation, but then they've also got to bring some creativity. Not that every idea, well, you've got to implement, but you've got to be hearing, okay, is there a different way? Is there a better way to do this that I'm not aware of? Your certified financial planner should be bringing that. That's what we tried to do today. So work with your CFP to see which of these concepts today you should implement. Don't just implement them in a vacuum. So, all right, that's all the time we have for today. Thank you so much for being with us. On behalf of Josh Gregory, Kevin Korhorn, and myself, and all of us at KFG, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.